James Pardo, How Buffett Does It, 24 Simple Investing Strategies from the World's Greatest Value Investor. Mighty Managers Series. Get ready to discover the secrets behind the incredible success of one of the world's greatest value investors, Warren Buffett. In this book summary of How Buffett Does It by James Pardo, you'll gain valuable insights into Buffett's simple yet effective investment strategies, which have turned average people into millionaires. Unveil the ideals of maintaining a straightforward approach, keeping emotions in check, being patient, and investing only in companies you truly understand. By studying accounting, cultivating healthy skepticism, and learning from Buffett's track record, you'll be well equipped to practice value investing, just like the Oracle of Omaha himself.
The simple approach to investing. Warren Buffett, one of the most successful investors in the world, believes in simplicity as a philosophy for investing. His method includes choosing a simple approach to investing, developing emotional balance, being patient, thinking independently, not becoming distracted by major economic events, investing in a few choice holdings, not being overactive, buying and holding, studying companies' bottom-line results, not choosing stocks based on their price alone, and taking advantage of unexpected opportunities. To apply Buffett's methods, it is essential to study accounting, cultivate healthy skepticism, and learn about his track record. Investing the Buffett Way. Learn the simple yet effective value investing approach used by Warren Buffett, which emphasizes investing in companies you understand and holding on to them for the long term. Warren Buffett believes that anyone can become a successful investor with the right approach. Contrary to the common belief that investing is a complex mathematical process that requires professional help, Buffett advocates for a simple and straightforward approach to value investing. The first rule of value investing, according to Buffett, is to invest only in companies that you understand. Don't try to apply complicated formulas or blindly follow the market. Instead, trust your own instincts and invest in companies with talented management and dedicated employees. Buffett learned this approach from his mentor Benjamin Graham, who stressed the importance of seeking stocks that are selling for less than their true value. Graham's strategy is to find companies that have great potential and are currently undervalued, and then hold on to them for the long term. He outlined this approach in the book he wrote with David Dodd, Security Analysis. Buffett has used this approach to turn small investments into huge successes. For example, he turned a $10.6 million investment in the Washington Post into a $1 billion investment, nursed a $1 billion investment in Coca-Cola into $8 billion, and grew his $45 million worth of Geico Insurance Company stock to $1 billion. He accomplished all of this using a buy-and-hold strategy based on a simple yet effective approach to value investing. Buffett doesn't rely on technology or complex formulas to make his investments. He trusts his own instincts and the principles of value investing that have served him so well throughout his career. If you're interested in becoming a successful investor like Warren Buffett, follow his example and focus on investing in companies you understand and holding on to them for the long term. Self-directed investing. Investment professionals don't always know best, according to Warren Buffett. Brokers earn commissions through high portfolio turnover, making self-directed investing a key strategy. While brokers are knowledgeable, value investing is a simple and anti-establishment approach they may not endorse due to potential loss of business. The rational investor. Investing requires a rational mindset, regardless of market fluctuations, wars, or company setbacks, as pointed out by investment experts, Graham and Buffett. Emotions cloud judgment, and reacting impulsively leads to losses. Investors must keep an eye on business performance rather than the stock price. Buffett's personal experience has taught him to avoid the Chicken Little mentality and to hold long-term investments even when tempted to sell during market downturns. Distraught investors do not possess the temperament to succeed in the market. The drop in stock price should not impact one's original investment decision. The key takeaway is to keep calm in turbulent times and avoid emotional investing, as success ultimately depends on rational decision-making. Buffett's investment philosophy. Warren Buffett believes in long-term investments and cultivating patience. He suggests creating a distinction between day trading and decades trading, advocating that traders should focus on long-term investing to achieve financial success. The stock market has become a hub where short-term traders and long-term investors move money around. Buffett advises that earnings and cash flow are two essential aspects of a successful company, and investors should search for certainty in uncertain markets by buying businesses likely to outperform their peers. The Omaha investors who held their Berkshire Hathaway stocks for over 35 years, and their investments have grown by over $100 million each, serve as an inspiration to patience value investing. Buffett encourages shareholders to view buying Berkshire Hathaway stocks as buying a farm or apartment building, an investment that lasts for generations. He leads by example and has never sold one share of his company's stock in 40 years. In summary, patience and a long-term mentality are crucial to financial success in the stock market. Warren Buffett's key investment principles. Learn from Warren Buffett's investment philosophy that focuses on investing in stable businesses with predictable outcomes and long-term growth potential. He advises being a business analyst rather than a stock analyst, examining the operations of businesses and comparing them to peers. Buffett also suggests investing in low-tech companies with loyal customers, strong cash flows, and well-known brands, avoiding high-tech, volatile, or gee-whiz companies. Additionally, he recommends consolidating rather than diversifying your investments, focusing on value instead of price, ignoring the stock ticker, and looking for bargains during bear markets. Buffett's investment ideas have been successful over the years, making him one of the most respected investors of our time.
In conclusion, the key to Warren Buffett's astounding success lies in his simple and straightforward investment strategies. The summary of How Buffett Does It enlightens you on the importance of maintaining emotional balance, staying patient, thinking independently, and investing in businesses that you understand. If you can learn to be skeptical of brokers, focus on the business operations rather than the stock price, and remain diligent in identifying great companies with talented management and dedicated employees, you too can be on the path to transforming your investments into lucrative gains. Remember, when it comes to investing, Buffett's mantra is to keep it simple.